Juan Aguilar, welcome to Acquiring Minds.
Thanks for having me, Will.
Juan, you were a searcher and are now an independent sponsor, for lack of a better term, pursuing 4 to 5 platform businesses with a long-term hold orientation. So there's a lot to your story, a lot of evolution. We want to hear about both of those things. So start us off, please, Juan, with some background on you.
Sure. Well, I'm from Guatemala, actually, so Central America, and I was born and raised here. I'm currently living here. Went to school in the States, so I went to school in Virginia. I'm an engineer. After studying engineering, I went straight into management consulting. I worked in Mexico for BCG for about 4 years. I did a stint in private equity in Mexico as well. Then went to business school, and right out of business school, started a search fund. And so that's how I got kind of introduced to the search fund world.
And why a search fund? Why not continue on the corporate path?
Yeah, so I was looking to do something that allowed me to go back home. So I was interested in going back to Guatemala. I was going to get married, and so thinking about an entrepreneurship in Central America, corporate opportunities are limited and not so attractive. I was also thinking about continuing in private equity, and also had limited opportunities in Central America for that. So I started learning about the search fund model in business school, and saw something interesting there, and found a combination of the investing part that I loved with the operating part that I felt I wanted to develop a bit more, and I said maybe this makes sense and we can give it a shot.
And Juan, were you somebody who was destined to become an entrepreneur or more of an investor?
Yeah, I do think I have my roots in entrepreneurship. I come from a family of entrepreneurs. My dad's an entrepreneur, and I wanted to run my own ship. I think that's the way I thought of it. And if the search fund route, if I have not done a search fund, I do think I would have started something on my own. Maybe not right out of business school, but probably a couple of years out after I don't know, probably doing private equity after business school or something like that. Yeah.
Okay. All right. But this allowed you to pull that plan forward a little bit and return to Guatemala.
Definitely.
All right. So, and this was what year that you?
This was 2016. I started my search in 2016.
And did you move back to Guatemala first, or did you actually get some of the search going before that?
I started kind of structuring and raising the fund early 2016 while I was still in business school. Moved back to Guatemala that summer and started searching, July, August, right after getting married. So.
Okay. Now tell us about the raise. This will be interesting to people, even those who are not in Guatemala, because you raised from people who were new to this concept. And so you had to explain and sell the concept to them, which you did. So tell us about how you went about this.
Yeah, so I like to say I did a traditional, non-traditional search fund. It's just kind of funny. I did raise funds, but the majority and the vast majority of my investors were first-time search fund investors. And although I do have a couple of, and literally 2, I guess, old school kind of search fund investors, non-institutional, high net worth individuals, and from the U.S. But those were kind of, I guess, my anchor investors that gave me the stamp to go back to Guatemala and raise funds from primarily, I like to call them friends. They're definitely my friends now, and people that I knew prior to going to business school, that they knew me through relationships in Guatemala, family and whatnot. high net worth individuals and business people, right? That's the type of investor I have, and I was looking for intentionally, and I was I guess thoughtful of this because of suggestions I received and conversations I had with searchers prior to me in Latin America, that they fortunately gave me the heads up and said, be very thoughtful of the people you select, not only because they will be extremely useful in the search. Searching in small regions is very network based, right? So in Guatemala, it was very important to have investors that had connections with the business community here, and I think that applies everywhere, but I guess maybe even more so in smaller markets, and also people that you trust and admire. That's, I guess, just the Warren Buffett way of thinking about things, and I really went about that seriously, and I guess I handpicked a group of people I felt really comfortable developing a relationship with, and it was a limited number of investors. So we had ended up, I think, doing it was 10 units, and I think a couple had half a unit. So we a very limited number of investors, and only three non-Guatemalan investors. So that's how I structured the search, right?
Great. And so to be clear, these are people who, the non-American, the Guatemalan investors are people from the business community in Guatemala, themselves successful in the Guatemalan context.
Yes, exactly.
And I think let's just make sure we're clear on the advice that you heard from other folks who've done searches in Latin America. You want local investors partly because they'll help you with your deal flow, and maybe more so. I mean, we hope that from investors in general, although you should really be clear about that with investors, because probably a lot of investors are not going to expect that they'll be providing deal flow to you. But in some cases, yes. But here, it sounds like that was really something that was going to be important because of the nature of the way the markets operate in smaller markets.
Yeah, and I think I'd add something else that is, in Central America and I guess other less transactional regions, or countries where capital markets are less developed and M&A activity is very limited. These conversations about buying a business are extremely rare for business owners, right? So it's very different to the U.S., where it's common conversations. It's dinner table conversations, bar conversations about I sold my business, he sold his business. That's very rare in Latin America, and especially in smaller markets. And so the soft introductions are important. Getting introduced to a business owner through somebody that he knows is going to make a huge difference as opposed to a cold email. And not only that, like once you're starting to have serious conversations around acquiring the business owner wants to understand who are you and who's behind you, right? And so having these local investors that could give us that backing of being people that had done business for many years in Guatemala, that people knew and respected, was extremely important. And to add to that, also we were able to get attractive bank debt to finance our acquisition, and it was very important for my conversations with banks to know who was backing the investment and the search, and that allowed them to have more trust in what we were trying to do. It was new for banks as well. This was, if not the first, probably one of the first, top three definitely searches in Central America. So banks were unfamiliar with the model, and we were able to kind of explain to them what was going to happen and how it was going to be attractive to them. And I think they had it was a good deal for them as well. So it still is a good deal for them.
And a large part of getting them to open their minds to it and entertain it and ultimately do lend you the necessary capital was because of the credibility of the investors that you had behind you.
Yeah, yeah, it's a small market, as I said. The business community is small, and so relationships matter. And my investors had, decades of relationships with the old school banks in Guatemala, and so that was extremely helpful. They introduced me to high level executives at banks, and once that got going, trust was there to start the conversation. So,
Juan, I'm zooming out on the way you put this all together. I just see kind of a domino effect. So or really that you use the credibility of one group to then get yeses from the next group. So it was the two U.S. search fund investors were the anchors to then legitimize you to the investors in Guatemala. Once you had that, you had gotten them on your cap table, then it was using their credibility to get you in the door with the banks. And once you had them and the banks, you were probably then the doors were opening to you with these owners. So it's very like you were parlaying one group's credibility into an entree into the next group. And maybe, I'm just kind of, as you tell us, I'm kind of realizing this, maybe this is how it always works, but it definitely seems like a very linear and logical progression there in your how you did this.
Yeah, it definitely was. I also had my ex-boss from Mexico was also an investor, and that was also the sequence of events there was probably the U.S. investors, then the partner from BCG in Mexico, and then the local investors. So it was definitely credibility building because, as I said, the local investors were all first time search fund investors. They had never heard of the model, so it was going to require some. They trusted me. They knew me, but they were also saying can somebody else tell us if this makes sense or not?
Yeah, sure. Well, good on you for having a good outcome. So making the ecosystem more open to the search fund entrepreneurs who come in follow your footsteps. Juan, and just give us a minute on, because this will be really relevant to people outside, as you said, kind of more developed M&A markets. What do owners in Guatemala think they're going to do with their businesses? If it's not selling them, is it just always an error? Basically they stay in the family and or what?
Yeah, that's a great question. And so as I said, it's really deep, I guess, in the culture of business owners here that businesses are family businesses, right? And they're like part of the family inheritance. So yeah, I think small business owners just know that the next necessary owner of their business has to be somebody from the family. So you typically see it go to like extended family, right? So if they don't have a direct heir in their like a son or daughter that takes over the business, I've seen cousins take over the business. So any other relative kind of kick in and take over the business because it has to stay in the family. That's just the mentality. But then again, you do see a bunch of businesses just wind down, right? So small businesses kind of tend to disappear after that first generation owner, as he retires, gets older. The energy is not there, and even if the cousin takes over, it's not the same thing, right? So there was definitely an opportunity, and that kind of ties into the business I ended up buying, which did have kind of an inheritance problem and another set of problems between the owners, but that was definitely one of them. The transition, the inheritance, who was going to take over the business in the next 10 years, and that's where the opportunity popped up for us.
And in these markets, though, would you say that the pattern of like the kids or even cousins, the next generation doesn't want to take it over is less common? In the States, you hear that, you know, the guy who started the plumbing business, his son doesn't want to be in that business. He wants to go make his own business career or whatever. I'm generalizing. So in Guatemala, same thing, or in general, most of the kids do, or somebody in the family does, in fact, want to take over the business?
Yeah, my experience, Will, is that it's definitely. I think it's a cultural issue. You know, the children, the kids of the business owner, I guess, you know, are brought up thinking this is what I'm going to be doing as a professional, right? I will follow in the footsteps of my father or mother with this business, and definitely in the U.S. you see that a lot less, and I think it's getting even more, or less common for people to think about, inheriting a family business. But I'd say I'd comfortably generalize there that I think it's still a Latin American thing. I see it in Mexico and everything, that it's just much more normal, I guess, traditional for people to think about taking over the family business as their kind of one and only option, right? And the smaller the business, I think that the more that you see that, and it's a combination of opportunities are less, available, I guess, and that naturally becomes an attractive opportunity, especially economically for the children. But also, people live longer with their families in Latin America, right? So you see in the U.S. that typically you get graduate from high school and then you're not coming back to your parents' house, right? That's not the case in Latin America. Most people stay and study in their hometown, and they live with their parents until they get married, and sometimes even after they get married. So it's just, the family, ties are stronger, and naturally that makes more sense for the opportunity to inherit the business and continue with the family business.
Yeah. Well, the picture you're painting, Juan, is of a very difficult market to find a business in. It's a much smaller market, and then even as a percentage of the available opportunities or the available businesses that you might want to buy, it's a smaller percentage of those that are not going to pass on to the kids or somebody in the family. So, with that, tell us about what your search then looked like. How did you find this business?
Yeah. And I think it definitely makes it more difficult. But on the flip side, you're dealing with a lot less demand also. So supply is limited, but demand is also limited. So we had very few. There's not a lot of people buying businesses here. There's no formal private equity. It's just uncommon on both sides to sell, but also to buy. So that, there's limited opportunities, but the few that there are, you're going to be probably the only one there, and creating this inception to the business owner about selling their business. So my search was also non-traditional in the sense that it was a pretty short search. So I started searching in August, and we closed the deal April 2017. So this was August 16. So it was 8-month search or so. Mm-hmm. And the business I acquired, I met the owners early November, right? November of 2016. I definitely say I was extremely lucky, Will. So I found very early on, I found a business that in a specific niche that I was looking to that I started out with a thesis of acquiring in, which was construction materials. There was a thesis that we believed, low income housing in Central America was booming and was going to continue to boom. The demographics here and the housing deficit were macroeconomic factors that were going to play in favor of specifically low income housing going forward. So we were targeting something there, right? And we weren't thinking about buying a cement company, but we were considering anything, roofing, flooring, windows, doors, and stuff like that. So I started mapping out the players in that industry or in that niche, and came across a door business that was not for sale at all, but that had an interesting profile, that one of my investors knew the owners well and had interacted with them previously. And he put me in touch, and turns out that they were two business owners, two partners that had started the business 25 years ago. And I think they were at a point where they were tired, over 60 years old, interested in thinking about transitioning out of the business. One had more of an operational role in the business. The other was just basically the capital partner. I think their relationship was being, had degraded a bit, and they were kind of a bit tired of each other for reasons I wasn't aware of, and they were very interested when I mentioned the idea of buying their business. Very curious, and we just started exploring the possibility. Fortunately, as well, they had started working with a financial advisor, so somebody that had started to help them put their the business in order, not necessarily to sell, but yes, to just have that just to get the books in order at least. Mm-hmm. And that was also extremely helpful for the negotiations. So let me stop there.
Because things were cleaned up for you to understand quickly.
Yeah. Mm-hmm. Yeah. I understand, like 3 or 4 years before we started these conversations, the business was, not ready to be sold. Like the books were not in order. So that was important as well. Yeah.
And so Juan, now we were talking earlier about generalities about searching for a business to buy in this market. So take some of those principles and apply it to this case. Did these guys not have heir apparents? Did they? I guess you had the credibility of your investor provided this deal. So perfect example of investor giving you deal flow. So I guess really just the heir question. They didn't have heirs, and even if they didn't, how did they respond to some young random guy wanting to buy the business? You still had to explain the search fund concept to them. So how did all that go?
Yeah. So they did not have heir. I mean, they both had. They both had kids, but none of them were in. None of the children were potential heirs. One of them had their kids participate in the business for several years, and then that didn't go well. And I think that was one of the factors that generated some sort of conflict between the two business owners. So that was off the table for them, right? They did not have the option of having someone from their families take over the business, at least from the direct families. They weren't that, like, I feel like they were on the flip side, they weren't like at the point where they had to retire. Like, they had some energy in them. I think they still do. One of them is still running a separate business that he owns. But they definitely were tired of each other. So this was more a situation where the reason to sell was solving the conflict that had generated from being business partners in a clean way, and mm-hmm. trying to conserve the friendship that they originally had, because they had considered one of them would buy the other one out, and that wasn't going well. So this was kind of a clean way to say, let's save our relationship, and let's take separate paths and make sure we're friendly going forward. but also the inheritance problem also played into the reasons to sell, right? And so the business, my investors, going to the other factor that was important, were extremely important in these introductions. I was, a 26-year-old guy, had spent the past 10 years of my life, almost 10 years living outside of Guatemala, doing other stuff. And so they were like, who are you? And what does this mean for us? But they definitely knew several of my local investors, had heard about the businesses that they owned, had heard about the reputation. And I think the logic was, if those guys trust him, maybe I can trust him. So it was a bunch of trust building at the start, right? So a bunch of, coffee conversations, just them getting to know me, trying to understand, what I was trying to do, understanding the search fund model. More so than the model, I think they understood the concept of like, I'm going to take care of your business and I'm going to be all in making sure that whatever you did transcends and is successful going forward. And so that was I think something that made a lot of sense to them. Yes, I was young. Yes, they probably said, you're going to have a bunch of things that you're going to learn along the way, and it's not going to be perfect, but I can trust you. And that got things going for sure.
26 years old. Man,
yeah.
that's
27, I guess. Just turning 27.
Okay. Well, now tell us more about this business. It fit into your thesis, so it was in residential home materials. Tell us more, please.
Yeah, so it was not, I guess, again, non-traditional or not textbook search fund, at least what they were teaching back then, because, it was, I remember at business school, it was just like, search for a B2B services, recurring revenue business and high margins. And
we're still teaching it that way, Juan.
Yeah,
I think.
Yeah, I think it's still that's still the boxes that you should check. I've become a bit more flexible in terms of things, and I think when you're searching and when you're geographically restrained, you definitely have to kind of draw outside the lines a bit and search outside the box, because there are other interesting opportunities. So this was manufacturing, light manufacturing. So we manufactured, residential doors, low income primarily, and this is not artisanal. This is high volume. So we're doing a bunch of doors, right, a day, and this is it's a very, I guess, unsophisticated light manufacturing process. There is, it's not services, but it is B2B primarily. So we're not direct to consumer. We primarily sell to distributors and retailers and constructors as well. Export, it's high export, and that was important for us because the Guatemalan market is limited and small, and so we wanted a business that could export and attend, the rest of the world basically, definitely not recurring revenue, but a bunch of reoccurring revenue and very sticky customers. This was a business that had probably, when we bought it, was probably 70 to 75% market share in Central America, right? So we were by far the largest and still are, and I think we're top 3 or 5 door manufacturers in Latin America. In high volume door manufacturers. So it was a significant business in terms of size within that niche, and had a very important market share. And that was part of the things that made me feel comfortable with the business, knowing that I wasn't acquiring a services high margin business. That was. So that was the trade-off I knew I was getting into.
But your thesis had been that you liked low-income residential construction in Guatemala, or did you see that being a trend across all of the whole region?
The whole region. So it was Central America. So we saw that trend. We analyzed that trend, and we're thinking about that play in Central America, not just Guatemala.
Okay, gotcha.
Yeah.
And give us a sense of the size of this business being one of the market leaders. What does that look like in Central America to be a market leading door manufacturer?
Yeah, so that was a business that when we acquired it was doing about $20 million in revenue, and we were doing, I think indoors we were producing when we acquired it was probably 35 to 40,000 doors a month, right? Wow. That was the relative size, and EBITDA was doing about a little bit under $3 million in EBITDA. Another kind of interesting metric is that the headcount was larger than what I was expecting to acquire, right? So I think we were like 250, a bit more than that, in terms of headcount when we acquired the business. And obviously that was a lot of people, in the factory manufacturing doors. That was primarily the operators in the factory, but it was a lot of people, right?
And so that's what does that tell us? That the business was inefficient, or that's just the nature of a business in Guatemala, where maybe it's more labor than mechanized, or what is that? What story did that tell you?
I guess I mentioned it because I never expected to from one day to the next become in charge of 250, 300 people, and then families, to think about the number of families you impact through this model. So it was frightening for me, and intimidating, I guess, initially. Then I saw it like a very cool opportunity to impact and to have an impact on a bunch of lives, a bunch of families. And it also, I think what you mentioned is also an interesting point, that it speaks to one of the advantages we have as a door manufacturer in Central America is that the cost of labor here is very attractive for these types of manufacturing facilities. So we've been evaluating certain processes to automate the door production and stuff like that, and things that other U.S. door manufacturers do a lot more often. It just doesn't make sense for us because the cost of manufacturing here is very attractive, and so we can hire more people to do labor intense processes and be more efficient than with robots. And I think it's a win-win also for the people that participate in the business, because they're we're generating jobs for a bunch of people that are in need for them. So yeah, that's also a great point as well.
Juan, tell us a little bit about how you structure a deal like this. So you've called your fund a non-traditional, traditional search fund. So the traditional part of that, was your cap table structured like a traditional search fund? What can you share there?
In terms of the terms for investors, is that?
Yeah. For the terms for the investors, and then for the deal itself.
Yeah, so for investors, traditional terms. I mean, here there are some variations, I guess, but nothing. It was pretty much from the Stanford Search Fund Primer. So traditional terms, the step up and everything else that the investors had that as well. In terms of the deal, as I said, we were able to. I think that was important in the way we structured it. So we were able to get bank debt. I was not expecting that to happen, to be honest. I thought local banks were not going to be interested in a deal like that, or would not understand the model, I guess. And we were able to convince them and to get very attractive bank debt. So we structured the deal. It ended up being, I think 30% of the total value paid was equity, and we did about, I guess, 50% of the bank debt, and then the rest was a mix of a seller note and an earnout. So we had in total, I guess, 70% leverage on that initial transaction.
Great. Now, tell us about, again, this is going back to 2017. So this is some years ago now. And you ran the business for 6 or 7 years before stepping out of it, which we're going to hear about. But tell us, I guess, start with what did you do with the business in these 6 or 7 years? Give us the big picture of your progress there.
Yeah. So the big picture of the progress. So I started running the business, and my first surprise was, I guess, a culture. My read on the culture was a bit off through due diligence, I guess. So once I started running the business, I did realize that the business was run like it was a one-man show in terms of the business owner, the one that was running, that was actually in the operations. He was a big micromanager. So the problem with that is that you have talented individuals in at the executive level that have a bunch of, I guess, retained talent or encapsulated talent because they were not allowed to express their ideas. It was the business owner was he would make all decisions, right, and he would question everything that everybody did and make sure he was involved in everything and made the final decision. So, and I was, I don't know if I was, by inception designed differently, or I wouldn't say like intentionally I was trying to not do it that way, but that just didn't fit in with my leadership style. So I'd say I'd made the mistake of trying to trying to fit my leadership style into that culture, and I quickly found out that wasn't going to work, right? So the first couple of, I guess, the first year was a year of understanding that I was not going to be able to work well with the key management, the high level management team, and so I started changing the top line and hiring new people that I guess I found more connections with. So.
And Juan, this was because the existing managers basically needed you to tell them what to do. They didn't express a lot of autonomy because they'd never really been given the room to do that before.
Exactly. I was trying to inculcate, extreme ownership and accountability, and we started working with EOS. That was immediate. That was 2 years in, I guess, to running the business. But especially when we started with EOS, I found that those people that came from the old school management team were not going to be able to run on EOS just because of the lack of responsibility they wanted to take, the lack of accountability, and the having someone question everything they did. That was just not going to fit in with the culture we were trying to build. Mm-hmm. So building the team, getting the right people on the bus was extremely important in the first couple of years, and that took time. It's not easy, and that was a challenge. I'd say 2 to 3 years in, Will, I really started to get comfortable, and I felt like now I have a grip of this. So some people, I remember when I was searching, would tell me, don't worry, it's going to take like 6 months to get a hang of the business and the industry. So don't stress about it. My experience was like, yeah, that's, I don't know if it's my industry, my business, but it was way more than 6 months, right? It took more time, and sometimes it takes more time, and you have to be patient, I guess.
And what, in retrospect, can you pinpoint what it was that made understanding this business more difficult? Is it the actual manufacturing process, let's say, or is it the market dynamics? I mean, is it kind of in the weeds stuff, or is it how the market functions, kind of bigger picture macro stuff?
Yeah, I think I definitely, it's a combination of all the things you mentioned. So one is that, manufacturing adds a level of complexity that you have to deal with, even if it's light manufacturing. And this is, we're not, manufacturing rockets, but we're piecing together things, and that implies, certain procurement issues that you have to understand, quality of materials, just quality of production, just taking care of the operators and the manufacturing process, injuries and stuff like that. So there's a bunch of factors that you have to kind of come to grips with and understand, that would, I think you don't have to deal with if you're dealing with the services business. Then again, you have to kind of, there's a bunch of SKUs, and the business that we acquired was doing a bunch of stuff outside of the core, right? So we were also manufacturing back then kitchens and closets, and we were also doing, we had a small like services business that was installing the doors. So we also offered the installation, which is a whole nother business, and it represents a bunch of challenges. So trying to understand, like, what are we really good at? Like, what is that one thing that we do that we can be the best in the world at? When you have so many variables is difficult, right? And so that, as I said, took some time, and I traveled a lot. You know, I went to trade shows. I went to visit our suppliers. I went to visit other factories to try to understand, you know, where should we be focused on, and that took some time, right?
Okay.
And so I would be back to like getting the right people on the bus. That was key, right? And so it's like I find this concept really important, which is like finding your who, I call it, like. So initially I was like very like how oriented is the way I'd say it. It's like, how do I do this? How do I solve this? And you know, a business coach kind of introduced me to this concept of saying, you know, stop thinking about that. Like, start thinking about like who, right? So who can help you solve this, and who knows the answer to these questions? And so I started working off of this, like, find your who, and became, I think, more efficient, at least at identifying people that could help me solve problems, and assigning them tasks specifically, and being very, very clear with what we were trying to do. And I think that kind of helped the flywheel start or get going in our business, right? And so once I felt I had a better grip of what was going on, and I felt I had the right people on the bus, I started, you know, thinking bigger and thinking about, you know, what things had to change and what we had to get rid of first to focus on our core. And that was the first step. So we made a bunch of changes. So we stopped manufacturing kitchens and closets and everything, and we said we're going to focus on high volume doors. And that was a tough decision to make, because it was uncommon. It was not what people were used to do less instead of doing more, and you know, revenue, we're sacrificing revenue, and it was just like, you know, a bunch of people were staring at me saying like, what are you doing, right? And but I was confident that, you know, we wanted to focus on our core, and in the long term that was going to make us more efficient and raise our margins primarily, and give us a better, more ability to serve the customer.
And you did this in what year?
So that was early 2019, probably.
So only 2 years in.
2 years in, yeah.
Okay. All right.
And so first was like doing less in order to do more, and then we made some also, I guess, more aggressive decisions, and started, I guess, two things. So one was built out a team to explore new markets, was what we called it. So we knew we had a high market share in Central America, and we got curious and started to explore other geographies where we could export our doors to. So we started to think about the Caribbean and opportunities we could find in the Caribbean, Colombia and Mexico, and started capturing some clients there, and started doing some sales first in the Caribbean. That became pretty attractive. And then we went into Colombia and started doing well there. And I was lucky to so we were about to invest in a new manufacturing plant in Colombia. Actually, this was late 2019, and COVID hit, and it made us kind of stop the process. I was about to sign a lease to for the facility where we were gonna set up the plant there, and the best thing that could happen to me was COVID, and for us to stop that decision and that investment, because the Colombian market struggled the years after COVID, during COVID and after COVID, and there was a huge devaluation of the currency, and that would have, I think, not been a great investment. So that was interesting. And a separate issue we did was a project where we evaluated a significant price raise and actually executed that. So we raised prices seriously, and I think that was a very difficult and impactful decision. So it was one of these, kind of moonshots and high risk, high return decisions that you make as a CEO. And yeah, we started, running numbers on that. That was late 2020, and essentially raised prices over 25% in one step, I guess. And this wasn't a sequential, like 2% towards 25%. This was one day to another, a 25% price hike in our products. And there's a whole story behind that, and how we thought about that. But that was probably one of the best decisions that we made as a team, and that it changed the profile of not just the business, but I think the entire industry. I think, doors were undervalued, and the willingness to pay for doors was much higher for customers. And so I think that not only benefited us, it benefited our, the entire industry, our competition. Yeah. And we know of other players in the rest of Latin America that followed our lead in terms of raising prices. So it was an interesting kind of change in dynamics that we led there.
Well, you say there's a story there, and we won't have time for the entire story, but can you condense it? Because certainly raising prices 25, 30%, all of that falls to the bottom line. I'm sure a lot of searchers and operators listening would like to be able to do the same. So what are the bullet points of how you got comfortable with such a big strategic bet?
Yeah. So the bullet points were, this was not my genius to just one day wake up and say, we have to raise prices 25% because I feel like that's a good idea. I am a big believer in, not reinventing the wheel, and just learning about concepts that have worked and understanding them and trying to tag along or essentially copy them. And so I tend to follow big players in the industries that we participate in other markets, in larger markets, and read their annual reports and read what they're doing and just be in the know. And so one of the bigger players in the door market, I was following, and I read about a price hike that they were putting forward. And so I started just kind of researching what they were thinking, trying to reach out and understand the details and go as much in the weeds of what they were thinking and what was going on there. So I even was able to get, some materials that they had worked with consultants with regards to the logic behind why prices were undervalued, why doors were undervalued, and why the willingness to pay for customers was higher. And there were studies that were being made about, compare other construction material products and how margins in those construction material products were way different than the door market. And also this concept of like the door will, if one fun fact is, I guess, a door, the whole cost of doors in a traditional U.S. home, right? So if you do the unit economics of the traditional, I think it's a 3-bedroom, 2-bathroom home in the U.S., doors represent less than 1% of the total cost of constructing that house, right? So, so what that means is that if, you know, the sensitivity to the price of doors is very low, because with regards to the total cost of the door, you know, it's really irrelevant a difference in the price of the door being, you know, 5 or 10%, right? So you can raise prices in doors 25%, and that's not going to impact the door, the cost of the home at all, basically, right? So there were a bunch of studies being run with regards to why there was an opportunity to change basically the pricing profile of doors. And I read about them, I learned about them, and then we started studying if it applied to the Central American market as well. And I think it did. And I was definitely like not, this wasn't one of those things where there was no risk and that I was like 100% comfortable moving forward, but I had I had high conviction that this was going to be successful. We ran a bunch of numbers and they made sense, and then we just you know, went ahead with a very important and sophisticated communication strategy, which was key, and where our main objective was to not lose trust with our customers. So you know, this is a hard message to transmit, like we're raising prices significantly, but we went through a whole set of, you know, communication strategies where we were explaining to them why this was happening, why this was beneficial for all, and why this could be an opportunity for us to grow as an industry. And I think that was a big reason why this was successful as well. So that's, I guess, a high level summary of the story. Right?
And what was the argument to your customer as to why it would be good for them?
So essentially, we went ahead and explained we were not. This is not direct to consumer, so we're working with retailers, distributors around the region. So we were saying, you know, this is not like us taking margin from you. This is you have to translate this to the market, right? So we had a whole strategy of how they should be able to transmit this to translate these price increases to the market. But then again, you also have to argue the incremental margin that we get is going to be invested in these initiatives that are going to benefit you as my customer, right? So we were talking about, you know, a better, you know, software investments that were going to allow them to have a better communication with us, right? So we had 3 specific projects that we were going to be investing in that were going to require like additional capex. And what we were saying is, if we generate whatever we generate from this price increase that's incremental to us, we will reinvest it in being of better service to you, customer, right? And we tracked that, and we're able to show it, you know, to them as the years went by. So the trust continued to be there, right?
And just finally, Juan, I mean, everything you're saying makes sense, but it still doesn't address the very obvious concern that a door, if all of a sudden your doors are 25 or 30% more expensive than the competition, then the end customer is just going to buy the competition.
Yeah, obviously. Yeah.
So how do you deal with that unfortunate dynamic?
Yeah, definitely. So you have to, yeah, that's the fear, right? And that's where, you know, you really get nervous is with any type, like, and I've experienced this with price hikes of, you know, 1%, right? And your sales team is going to say, like, I'm not raising prices 0.5% because I'm going to lose, you know, to my competition. You again, if in our case, and this may be specific to our industry, but I think it applies to several other industries, is if your only lever and differentiator is price in a market, then you have other problems, right? So if you can only protect your share through price and being the lowest cost producer and the lowest price on the market, I think that's not a long-term strategy that holds, right? So you have to strive for having other differentiators that allow you to win over customers in the long term, right? So we were comfortable letting go a whole bunch of customers, and we had modeled out, a bunch of lost sales that we were okay with, because we felt that these were customers or clients that were only interested in price. And if they were not willing to value the quality, the service, and the volume that we could supply to them as differentiators, and the most important of those three was service for us. So and attention to the customer. Then that was not a customer. That was not our target market. That's the way we thought about it, right? So we knew that we would have some sales that would be lost to our competition. We also knew, and we experienced this, that we would be creating competition through this strategy, right? So and that happened. So 2 or 3 years after this price hike, we had new door manufacturers in Central America that were selling doors at 10-15% below our price, right? And we you go through the fear of like, is this going to be relevant? Is this going to make us lose share? But if you stick to your guns and make sure that your differentiators are strong and you're focused on, in our case, it's service, quality, and volume, that makes us different to the rest of the market, and nobody else can do those three as well as we can in the market. In the long term, I think you survive, and I think those low cost competitors are just stints in the road that make it difficult for you a couple of months or maybe a year, but then they fade out, and you're able to play the long term here. So that's where, and we're in this for the long term. So that's the way we think about it, right?
Well, and then you have the other happy possibility that sounds like it's come to pass, where if you're the bold one that raises prices, and then eventually the market follows suit because you've created room for everybody to raise prices, then you don't even look like you're high priced compared to the competition, because everyone just catches up with you. And so then you continue to have all your differentiators, but you're not even positioned as particularly premium cost, because everyone has also raised their prices. So I guess you really hope that happens. Fantastic. And so at the end of 6 or 7 years, what did the business look like after your tenure? Well, you're still an owner, but your direct tenure as the CEO.
Yeah. So the business had grown, and we were able to, we essentially doubled the business. We doubled EBITDA and doubled revenue, and the EBITDA doubled before revenue doubled. So we did increase margins, obviously, through this price hike. The margin profile of the business changed significantly. And so this was 2021, and end of 2021, we were doing over $6 million in EBITDA and about 30 in revenue.
Fantastic.
So yeah, so it was primarily due, as I said, I think it was the change in prices was important to the growth of the business, right?
Great. So a $6 million EBITDA business. Now in the Guatemalan market, how many such businesses are there? There are probably, well, there's obviously a lot fewer than there are in big countries like the US, but I guess what I'm trying to say is going from 3 to 6 million, because the population of companies is smaller, that puts you at a different level, and the levels are far less populated as you go up the chain.
Yeah, so we would consider ourselves a medium-sized business in Central America. It's so yeah, and medium to large, I guess. And it's hard to say. Also, businesses here don't, are very private in terms of the numbers, so it's hard to say
Yeah.
how many of what size. But we definitely fall in the category of medium to large business in Central America, right? And there are a bunch of small businesses in Central America, a bunch of mom and pop shops, but limited number of businesses, I guess, above the $3 million EBITDA hurdle.
Right. And so there you are at 6. And of course, to really get a sense of how large this business is in a Guatemalan context, you'd have to kind of do the currency conversion. So $6 million in EBITDA is a lot more money in Guatemala than it is in the States. So it's relatively a much more kind of cash generative company than it would be here. And even here, $6 million in EBITDA is, that's a fantastic business.
Yeah. Yeah. And the cash profile of this business, which is important for us, is very attractive. So we don't require a lot of CapEx to increase our manufacturing capacity. Again, this is a very, automized process. It's very labor intensive. The machinery we need is not complex machinery. We're working with wood. We're working with unsophisticated materials. So CapEx is very low relative to other manufacturing companies, and that allows us to grow the business with a high cash flow generation characteristics that are attractive for us in the business.
Okay, so what take us kind of to the end of this chapter of the story of your tenure as CEO in the business? What year is it, and what decision do you make?
So when it was 5-6 years in, the business was fortunately doing well. I felt like we had stabilized and we had the flywheel going, and the management team was up and running and taking care of things. Also, I felt like it was a different business. It was a much larger business. We were growing in new markets. There was untapped potential to keep growing the business, and I started to get a hunch of wanting to go back to the investment side of things. And as we talked about earlier, Will, I was always also a very financy guy, interested in investing. I love the operating part of all of this, and still do. We can talk about that a bit more of that, which is interesting. But at that point in time, I was thinking about like investing, right, and saying like, I think there are more opportunities like this one, and we should capture them, right? I had a friend, one of my best friends, from childhood, who was also starting a search back then. And what we did is we essentially partnered with the same set of investors, backed him in his search, and he was searching in Guatemala as well. And so I was following his search and helping him out and saying, I think we saw a bunch of opportunities that were very attractive, but maybe not search fund like deals because there were minority deals, or there were, we're not checking all the boxes in terms of the search fund deal. But I spent a lot of time helping him. Long story short, again, given the trust and friendship I had with my investors, I had open conversations with them about, saying, can we transition? Is there a way I could transition out of this role as an operator and keep on doing, investments with you guys backing me, and make sure this door business is taken care of? And they were very open to those conversations. So I started exploring, how this could make sense. And so we ended up doing a couple of things. First, it was important for me to clean the table with my investors, and even better if we could generate some sort of return. And so make sure we were playing with, house money going forward. So as I said, the business was doing well. We had generated a lot of cash and paid down debt, and so we were able to do a sort of a dividend recap, or special dividend through recapping the business with debt, and that allowed us to distribute, back money to investors, generate a return. I was able to vest my carry, and the other thing we did, and I worked a lot on, was find a great manager to take over the CEO role and to transition me out. And I think that also was important, because I also felt like, maybe this next stage, is there. I was sure there was somebody out there that could do it better than me, right? So I was interested in finding someone that was a great operator and that would take care of the business going forward. I was going to support him, and I was going to continue participating as a board member, but he would be running the show. And I was fortunate to find the current CEO of the door business, who and hire him, and he's now running the show there. And we're still business owners. We're still running. We're still the owners of the company, and I participate as chairman on the board. But he is fully in charge. I'm no longer in the day-to-day operations of the business, and the business has continued to do incredibly well. So very happy with that transition and how those things kind of played out, right?
Anything to say about finding your who, in this case, finding the CEO?
Oh yeah, there's, we could do a full hour of that. Yeah, I there's a bunch to say there. Generally, in hiring, the way I think about it is, again, people I can really trust. But for this role, it's by far I now have some experience hiring CEOs, because I think we'll get to that. But we're now doing more investments and assigning CEOs to run the businesses. But I think finding a CEO is difficult and different than hiring someone from the management team. So someone for a specific role. The CEO has that particularity that it's somebody that's, has to be good at everything, and not specific on something. So it's complicated. But I was looking for somebody, first of all, that had this kind of entrepreneurial rigor. So, you want somebody or we wanted somebody that was just scrappy, a doer, owner mentality, but at the same time analytical and rigorous, right? So finding that combination is tough. I wanted somebody that I could, trust from the get-go, and that was very candid and open from the get-go and had demonstrated that in the past. And I was looking for somebody that was coachable as well. I think that those were three traits that were very important to me, and that had demonstrated an ability to a growth mindset, somebody that was willing to learn. And I'm more of I prefer to hire people that are, that may not have the title, that may not have previously had the title of a CEO or a general manager, but are right there and have all that hunger and drive to get to that position, and go through that kind of phase where they're going to learn a lot and make a lot of mistakes, but that they're going to be hungry and driven. As opposed to somebody that has proven out his, all his skills as a CEO and has, that title for 10 to 15 years, but doesn't have that drive anymore, right? So the CEO that we hired for the door business was exactly that. He was just ready to become a CEO. He was extraordinary at what he was doing in a large corporate where he was previously, and was very interested in this model of small to medium business, full ownership, participating in the equity as well, and somebody that I knew, I had known previously as well. So he was trustable, and we had a great relationship, and yeah. So I was it was an easy transition for me actually, and I'm really happy to have him on the team.
Fantastic. And Juan, tell us more about the dividend recap. So I'll just take a stab at big picture. You had paid down a lot of the debt that existed. You were generating a lot more cash at this point. So you could get more debt back onto the business. The business could support a bigger debt payment because it was generating so much more cash. And then with that loan, pay yourselves back. So pay your investors back plus a return, pay yourself, have a big liquidity event for yourself. The business then carries forward with a new loan, and everyone, the lenders and you all are very comfortable that it can support that loan. You've now been in the business for 6 years and gotten it to $6 million in EBITDA, and retain all of your equity, right? Is that essentially it? Anything more to say about that? I mean, that must have felt good. You basically had an exit without exiting the business.
Yeah.
You had a liquidity event without exiting the business, I should say.
Exactly. Yes. But yeah, that's pretty much it, Will. So you're relevering the business. So in our case, we relevered the business to the levels that even below the levels that we had levered it at acquisition, right? So it was not something that it wasn't taking leverage to a new extreme. It was just relevering up to where banks had originally lent us, right? And and that's because, again, the cash generation and the growth had allowed us to pay down debt significantly, right? And with that, influx of money, you declare a special dividend that you pay out to investors. And we also, given that I was transitioning out of the CEO role, we had to kind of restructure our shareholders agreement or make amends to it because investors were now going to participate in a different thing from what they had originally signed up to. Another interesting fact here is that once you do this, like, you're now really playing the long term, right? So now you can really think about, okay, you've cleared the hurdles, you vested, there's no like IRR to be thinking about, right? So as a searcher and as the original investors, you're now saying, okay, cool. We've cleared the hurdles. We've made the money we want to make here, and now we really want to play the long game. And so we're now thinking about MOIC, just kind of permanent capital, compounding the cash we generate from this business, and trying to make this as big as we can for over the long term, right?
And Juan, if you can, a business that's doing well, you can dividend recap it and pay the investors back plus the return they were looking for, and then continue to retain equity and think about it for the long term. Why don't you see this as a more common liquidity event in the search fund space? The default is sell the business outright.
Yeah, that's...
this sounds so much more attractive. You had a payday, and by the way, you still own the company forever.
Yeah, that's that's a great question. I guess you're probably, so first you have to have the financial conditions to be able to do this, right? So that I guess that's the first question is. Not all businesses are in the financial capacity to go through an event like this, right? And I do see an argument from investors if this wasn't a significant special dividend where you're generating a significant return and you're just returning capital. I do see the investor saying, let's not use this money to pay us back our capital. Let's look for other investment opportunities, right? One conversation, we did have the conversation with investors of should we just sell the business now, right? So
Yeah.
let's explore this. And we did have some conversations with the bankers and started exploring the idea. But quickly we found, that a couple of things. One, as I said, the financial conditions were there. Interest rates were very attractive. So this was 2021. So you get, I think we all recall what interest rates were back then. It was just in time to do this, right? In terms of debt.
Good timing. Wow.
Good debt, right? And also, there weren't clear avenues to deploy that capital for the business at that point in time, right? So why don't other people do this, even if they can check all these boxes of like being in the financial capacity to relever and declare a dividend like that? I can think about, maybe because there's other uses of capital allocation, so great investment opportunities. In our case, it could have been another manufacturing plant. It could have been, buying a bunch of robots to automate the production process and everything. But none of that really made sense for us. Or acquiring another business within the door manufacturing industry. Nothing made sense for us at that point. And at the same time, we saw a great potential in the business to continue generating cash over the long term. So we said, and that has happened. We did this back in 2021, end of 2022. And we're now, we've basically reduced our debt back to the levels where we were prior to that dividend recap in just a couple of years, right? Because the business has continued to grow and the cash generation has that same profile. So I think, as a searcher, ideally you want to find a business, and we're, when we talk to searchers, we're constantly drilling them on find businesses that have other liquidity avenues that are not necessarily selling the business. So focus a lot on the cash generation of your business, understand the cash profile, understand the needs for CapEx, because you always want to have some sort of flexibility to do something like this in case, the market is not there for selling, or in case you want to play the long-term game and have these conversations with your investors. So I think, one, people don't buy these types of businesses, right? So you have high growth businesses, but that are not necessarily generating a bunch of cash, right? And two, I do think people don't stop and think about other opportunities of capital allocation once they have a bunch of cash, right? They just think about like, now I have to invest this here or there, or now I have to acquire this other business because I want to grow. But I would invite everybody to stay and just like stop and think. And for example, if you haven't read The Outsiders by Will Thorndike, I think that's a great book that every searcher should read. And just like think about the other avenues of capital allocation, right? And what other options are out there for you to use the cash that you've generated. And this being one of them, I think is a great way and use of cash.
Well, it sounds like, frankly, just a stellar outcome, Juan. I mean, to say what I said before, everyone had their payday, investors got paid back plus return, and you still own the business, and then it's continued to grow. So you could do the same thing again. I mean, it's really serving as an ATM machine that spits out more and more money. What you said about as you now invest in searchers yourself, drilling them on making on evaluating businesses with an eye toward being able to have optionality in the future. Did you just mean, basically profitable businesses that aren't super growth dependent, that they have attractive fundamentals, that if they don't grow, they can be very attractive cash generation machines? Is that what you meant?
Yeah. So I ask them to think a lot about like just really understand the cash flow yield, right? So free cash flow yield of the business, year after year. We don't like put a necessarily like a hurdle or make them think about a specific number, but just like you want that to be high. You want to understand how it works. You want to understand the working capital like profile and needs of the business, right? You want to understand CapEx. Those are all like variables towards free cash flow. but I guess our experience now as investors, because that's another conversation, but we're also investing in search funds in the US and in Latin America. Our impression is that there's a tendency to think a lot about growth, and that's good. I mean, everybody wants the businesses to grow and everything, but sometimes sacrificing at least the understanding the cash flow profiles of the business, right? And we've all heard the saying that cash is king, and we're more interested in this free cash flow yield than growth. I'd say that outright. Like we don't really care that much about growth in businesses. We're really interested in the free cash flow yield because of this experience that we've had, right? So. Not sure if that answered your question, though.
That was a great one. It did. Well, and it may come back around again with my kind of closing questions here. We haven't left a lot of time for it, but let's hear now about what you're doing. You've pivoted into, let's call it, an independent sponsor. That may be kind of shoehorning that label onto you. What did you do when you stepped out of the door business?
So I partnered with the friend I mentioned previously that was also doing a search fund. He searched without acquiring, but we created this pipeline of deals in Central America that was extremely attractive. And since we've been patient, because that pipeline has been maturing over 5 years now, some of the deals that he started, some of the conversations he started 5 years back with business owners are now maturing into possible acquisitions.
Juan, so you're telling the audience it takes 5 years from that first conversation to actually for an owner to be willing to transact?
So yeah, in these, at least in Central America, we have our experience has been that you have to be much more patient, and maybe that 2-year time window that you have as a searcher is tight, because you might get lucky like I did, but if not, more common scenario is that business owners just take a lot of time to come to terms with the idea of selling their business because of this, the whole family legacy and, how important it is for the family and inheritance, as we mentioned earlier. But so I would say more than an independent sponsor figure, we're trying to, because we're still working with our original investors, which is great, and we love that. We've acquired another business in the same sector, like construction materials, and we also own 100% of that business. We've assigned an extraordinary CEO to run that business as well. So very, very similar model to the door business. It's light manufacturing as well. We currently have another business under our LOI in the same space, same characteristics. So we're trying to close that third acquisition soon. And our idea is to own these businesses under a holdco model. We like to call it more a platform model, because we're thinking about being specific to an industry for now, and then venturing out to try to platform number 2 in another industry. But we're trying to leverage our expertise in this light manufacturing construction materials sector as much as we can, and also ride kind of the tailwinds that this industry has, because we do see Central America continuing to boom in this segment, and so we're trying to ride that wave through a vehicle that allows us to own these businesses for the long term, right? Backed by our original investors. That's the whole plan. Separately, as I mentioned, we've also with my same business partner, we've raised a fund with primarily local Central American investors, that the original ones and others that have found the search fund model interesting, and we're investing in search funds globally, primarily in the US, but globally, and backing searchers in a very. This is a small fund, so we're not like large institutional investors, but we want to back a set of 5 to 10 searchers every year, and be as helpful as we can to them. It's our way to give back to the ecosystem. We received, a bunch of help, and all of these ideas that I've mentioned were backed by searchers who had done this previous to me and done it well. And so I'm very grateful to the search fund community, and grateful to folks like you that put out all this material to make the adventure more more palatable for us as searchers. And I'm just trying to give back, right? So that's the way we think about investing in search funds as well.
And you said investing in searchers in the U.S., but also globally. Given your being situated in Central America, does a global searcher or non-U.S. searcher, should they feel more like they should reach out to you? I mean, I guess maybe is that a differentiator, do you think, compared to other search investors?
Yeah, so I think we're happy to talk to searchers anywhere. To be honest, we do have a mandate so the majority of our fund is going to be invested in the U.S. Right? That's just because of appetite from our investors and LPs and the way we structured it. But we do have a bunch of conversations with non-U.S. searchers, and we have a bunch of experience to share with them. So, and even if we're not investing, and we have conversations with searchers all the time to help them out and just be helpful in terms of how they're thinking about structuring their fund or the deal. So happy to talk to anybody that is thinking about a search fund.
Great. Okay. Well, I want to go back to the holdco, or the platform investment firm. You're closing the third, or you've got the third acquisition under LOI, and so are you then looking? Those three will become the platform, or the door company is the platform, and these are bolt-ons. And this is all just kind of sounds like it's in year one-ish. You exited in year or you did the dividend recap in 2022. So I guess we're 2 years later. Are you going to continue at I guess, what are some of the goals in terms of acquisitions or revenue numbers and size? I guess year 5, call it.
Yeah, so we're looking to acquire these are not bolt-ons to any of the operating business. So the idea is to structure that's what we're currently doing, structuring a new co that will own. So it would be like the new co would acquire each of the operating business, but that would just be kind of a share swap from investors. And from this new co, hold co, whatever we call it, we would acquire. We're targeting owning 5 to 7 businesses in total, right? Within this segment, the construction materials niche, right? But again, we're very scrappy. Will I even struggle to say like 5 to 7? Obviously, we have to put some numbers on the document that we share with investors to give them a sense of what we're thinking. But I always say, could we keep it with 3 and just do 3, or do 5, or do 10? Yeah, I mean, we want to be flexible. But the idea is to use the cash flows that are generated from these operating companies to acquire more companies, right? And get to that flywheel where we're using the cash that the businesses generate to grow inorganically within the same niche, and compound, and hold these for the long term, right? So
when you say hold for the long term, therefore, the returns to investors are happening on a regular basis as dividends, as opposed to some big liquidity event, because long term means that liquidity event is too far away. So you're going to be using the cash to not only make new acquisitions but also pay dividends in the meantime.
Yeah, we're gonna use the cash. We're gonna make the best capital allocation decision we can at each point in time, right? So if there is nothing interesting to invest in at that point, we will dividend out, right? And or we will buy back shares, or we will do something that gives liquidity to investors. But if we find other attractive opportunities, acquisitions specifically, we will acquire other companies and keep growing the holdco. So that's the way we think about it, and our investors are clear that this is a different model. Like, this is not the search fund model, right? This is a long-term hold vehicle, and so we're no longer thinking about IRRs. We're thinking about money on invested capital, and trying to grow this as much as we can, and as I said, compound the returns.
Juan, for the listener who might not understand this shift in mentality from IRR to MOIC, MOIC, what does that mean? Say more about that. Say more about that, please. That's an important concept, and one that maybe not a lot of people, or not everybody listening, are going to really understand, even if they understand the definitions of those two things.
Yeah. So typically, I guess the majority of investments, financial products and everything, are thought of through IRR and just returns over a period of time. So it's not just how much money you make on an investment, it's how much time you make that money, right? And so you're trying to clear these return hurdles that have a time variable that's important, and that as you take more time to generate returns, that your IRR is going to fall, right? But here we're playing, as I said, this game of compounding, right? So and this comes from the Berkshire model, Warren Buffett, and this philosophy of the magic of compounding. So once you're in these investment vehicles that are long-term permanent capital vehicles, right? You're no longer thinking about time as a variable to optimize for, right? So the IRR hurdle starts to I guess I wouldn't say it no longer matters, because you're obviously trying to maximize returns in any sense, right? But
yeah,
what you're really striving for is money on invested capital, and as opposed to like thinking about doubling your money or 3 times your money, you're now thinking about like, we're gonna 100x your money, right? So we're really thinking about in 20 years, in 30 years, this is going to be 100x, right? And the IRR on that is going to be extremely attractive, but we're not really thinking about that. We're thinking about compounding your money for the very long term, right? And so I guess the search fund model is designed to also think about time, and most search funds are structured through IRR. At least that's what I still understand how things work with IRR hurdles. We've been we've argued that a good model for search fund investing should be MOIC hurdles and IRR hurdles. So you should be trying to clear a MOIC hurdle and an IRR hurdle if you're doing a traditional search fund. But once you migrate into this kind of, especially for example, in our door company, when we've cleared IRR hurdles, we've returned capital to investors and generated the return that they were expecting. As I said, we're playing with house money now, and so what we're trying to do is really just make that money as big as possible over a time horizon that we're not sure how many years that might be, but we're just really thinking about compounding that capital.
Well, I struggle with this one. I have to admit, because I'll call it MOIC, the money on invested capital, or multiple on invested capital. If you 10x my money in 10 years or 10x my money in 20 years, those are both long-term, but those are both very different outcomes.
Yeah.
So it still ultimately always comes down to time of investment. This is what I don't understand, how returns can ever be decoupled from time frame.
Yep.
Is it just that, like, when you start thinking in 15 and 20 and 25 years, it's just too hard to predict, so you're just you allow yourself to be a little vaguer? Is that what it is? And just to go back to the Berkshire Warren Buffett example, you'll often hear about like what is Warren Buffett's performance? Well, it's basically low 20s IRR year after over whatever it's been, 60 years. So when people are really studying Warren Buffett, they still kind of tie it back to what his internal rate of return has been over this amount of time.
Yeah. I think that's a great question. Well, so the way I think you have to think about it is why does it matter, right? So one reason why as an investor this should matter is like, so how are you paying promote on the investment to the manager, to the GP, or to the searcher or whatever, right? So that's one reason why it matters, right? Because it's as you said, it's not the same to double your money in 2 years or in 6 years, right? So one thing to be clear, it's like we're not ignoring the IRR. So for example, in the way we think about structuring promote for this long-term hold vehicle is you're going to get paid as the founder of this model for doubling the money, for doubling each time you double MOIC for investors. Mm-hmm. You're going to get paid. We're going to get paid. Mm-hmm. But we have to clear a preferred hurdle, right? Which is IRR. So we're when we look back, when we double the net asset value of the investments, we look back and we have to make sure we cleared an 8% hurdle, right? So mm-hmm. if you doubled over 40 years, you're not going to have cleared the 8% hurdle. So we're also, I guess, we're not ignoring the IRR. We're definitely making sure it clears a hurdle, mm-hmm. but we're not using IRR as a primary benchmark, because mm-hmm. then you're incentivized to generate as much liquidity in the short term as possible to maximize your IRR, right? So mm-hmm. so decision making is another reason why it matters, right? And that's why traditional private equity, you're seeing all these flips and businesses being sold in 3 to 4 years, right? Because obviously that maximizes IRR. Mm-hmm. Another interesting reason why it matters is the use of debt, right? So debt becomes an interesting thing to think about once you structure these long-term hold vehicles, because debt is very attractive in private equity deals, because it that really bumps returns, right? So it's gonna really help you juice up your IRR, especially if you're doing this for 3 or 4 years. Once you're going for really long term, right, 20, 30 years, yeah, it's going to help you bump returns, but not in the same way, right? And so you think twice about using debt, especially if interest rates are high, because it doesn't have that same effect as if you were playing the 3 to 4 year game, right? So it's just different, right? And so I guess to answer specifically your question, the way you have to think about it is, we're not ignoring IRR in these games or in this model. We're just making sure it's not our primary driver, right? Our primary driver is multiplying your money, MOIC, okay, right?
Well, thank you for that. Thank you for that one. It was great. Well, I want to close this out here with basically just kind of have you reflect on the difference in what you're doing now versus being an operator. You said earlier in our interview that you really loved operations, but you're now obviously mostly a capital allocator. You're an investor, so it's a very different profile of day-to-day life and trajectory of career. So maybe compare and contrast, and in a way that might be relevant and helpful for the audience.
Yeah, and it turns out that the grass is always greener on the other side, I guess, because I was running the business, and I guess 2021, I was like, I'm ready to go back to the investing side and use my investor hat and start running analysis and doing deals and stuff. Then, I was, after a couple of years of doing that, I started saying, I want to be in the trenches again. I want to start running. I want to be in the operations again. And I did spend some time in the day-to-day operations. I was a temporary CEO, I guess, of the second business we acquired. And I really enjoyed that. I don't know if that's even possible, but I see myself like going forward, switching hats constantly, and if I can buy myself that flexibility of being able to participate in both temporarily, I guess, and not losing the ability to spend some time in the trenches with the operators, with the management team, doing EOS and all that. I love that. But I also feel very comfortable and enjoy participating in deal making and deal structuring and negotiating acquisitions. And so maybe I'm just somebody that's very dynamic and gets bored of doing the same thing for long periods. So I want to be, I think another interesting thing is that this model that we're building out, this Holdco, I guess, allows for that. And that's something that I find very attractive as a professional development opportunity, I guess.
Well, it's probably a good thing, Juan. I mean, at least a good thing given that you've built something for yourself where you have the flexibility. If you didn't have the flexibility, then you'd always be chafing and wanting to get back to the other thing. But given that you have this freedom to go back and forth, it's again, to use Warren Buffett, I think he says, his quote is, "I'm a better investor because I was a businessman, and I was a better businessman because I was an investor," or whatever.
Yeah.
I mean, these are highly complementary, needless to say. And yet most people probably just prefer one or the other, operations and being in the business versus being capital allocator. So if you are a personality that can enjoy and does enjoy both and actually gets an itch to do both, you'll be able to travel back and forth and bring the learnings from one into the other and vice versa. So that seems like a really happy characteristic of yours.
Yep, definitely, for sure. I really believe in that quote by Warren Buffett, for sure.
Yeah. What haven't we talked about, Juan? Did we get to everything?
What haven't we talked about? Yeah, I think we covered a bunch of ground, and nothing big comes to mind. So,
okay. If people want to reach out, Juan, what's your preferred method?
I think LinkedIn is probably the preferred method for me. I check that often, so people can find me through LinkedIn, and yeah, through we can, like, if you're a searcher, we have a website that has a good communication tool, and you can reach out there, and happy to get in touch. So,
what's the URL?
It's paltuscapital.com. So,
Paltus, Paltus.
Yes, capital.com.
Mm-hmm. Great. Juan Aguilar, thanks for so much time. Thanks for walking us through your journey. Really a fascinating one. And seems like what are you now? 34, 33?
34. Yeah.
34. All right.
Yeah.
Well, lots to come in your career. So it'll be fun to watch. Thanks, Juan.
Thank you, Will. This was great. Really appreciate it.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come, stories that will help you along your own path to acquiring a business.